Welcome back to The Explainer. Today, we're putting on our detective hats to uncover the real story hidden inside the corporate filings of ICU Medical, ticker symbol ICUI. They just posted a really strong Q1 2026 earnings beat that definitely caught Wall Street's attention. But our mission today is to figure out what that actually means. Does this recent beat signal a massive ground floor reset opportunity for us? Or is the stock already pricing in all of its future growth? Well, let's decode the numbers and find out. Okay, we are diving straight into a glaring valuation gap that was just highlighted by the analysts over at Simply Wall Street. Based on their models, they're projecting a fair intrinsic value for ICU Medical of roughly $180 a share. But if you look at the recent trading price, the stock has been hovering right around $129. I mean, that is a steep discount of over 25%. And whenever you see a gap like that, you immediately have to ask yourself why the market is pricing in such a massive discount to the company's underlying value. And what we're looking at here is a fascinating tug of war between short-term momentum and long-term pain. When those Q1 2026 results dropped, short-term momentum completely took over, and the stock popped over 4.5% in just a single day. But zoom out a bit. Long-term shareholders have endured a totally brutal ride, suffering a 37% loss over the last 5 years. So the mystery we have to solve is whether this recent bounce is just a momentary blip or a genuine inflection point building off a really low base. Now, to understand the math today, we actually have to look backward at their SEC 10K filings. These documents lay out a multi-year corporate transformation aimed at streamlining the entire business. This whole thing really kicked into high gear in 2022 when they took on the massive integration of their Smiths Medical acquisition. Then, in 2025, they executed a $30 million restructuring plan to handle things like facility closures and severance. And finally, later in 2025, they pulled off a major structural shift by divesting 60% of their IV solutions business into a joint venture. So what's the actual strategy behind all this reshuffling? Well, divesting 60% of that IV solutions business last year naturally lowered their headline revenue. Obviously, you can't sell off a huge chunk of your company and not see a drop in total sales, right? But this was a highly calculated move. The goal was to literally trim the corporate fat, shedding the less profitable segments so management could focus all their capital and energy strictly on their higher margin core products. And you know what? That strategy is absolutely paying off. Just look at this massive swing in profitability from their Q1 2026 AK filing. They went from a $15.5 million net loss last year all the way to a $30.1 million profit today. I mean, that is a drastic bottom-line turnaround, and it's exactly the kind of fundamental shift that makes analysts want to upgrade a stock. Now, here is where you really need to look past the flashy headlines. If you just skim the front page of the earnings report, you're going to see that total GAAP revenue dropped 12% year over year. On the surface, that sounds terrible. Actually, scratch that. If you strip away the divested IV solutions business and adjust for foreign currency impacts, their non-GAAP organic revenue actually grew by 1%. So the core engine of the company, the part they're actually keeping, is completely stable and inching forward. And this whole turnaround story brings us to what is arguably the most critical metric for any company undergoing major structural repairs: free cash flow. It's exactly what it sounds like, the actual cash a company generates after paying for operations and maintaining its assets. It's the true lifeblood of the business, telling us exactly how much real cash is left over to reward shareholders, or more importantly in this case, to fix the balance sheet. For ICU Medical, that free cash flow number hit $27.6 million in the first quarter. That is huge, because it gives them much-needed capital to tackle the absolute elephant in the room, their massive $1.28 billion long-term debt. Look, when you're sitting on over $1 billion in debt, generating consistent free cash flow isn't just a nice little bonus, it's absolutely vital for survival and for de-risking the company for investors. So, knowing all this, let's dive into the bull case infusion pump replacements. Why did analysts at Needham recently upgrade ICU to a buy? Well, the bullish narrative really hinges on this dynamic captured by Simply Wall Street. They point out that the multi-year replacement cycle for ICU Medical's huge installed base of infusion pumps is only just beginning. Hospitals clearly don't replace this heavy equipment every day, but when that cycle does kick off, it creates a massive refresh opportunity that's expected to drive highly recurring cash flows starting next year. And it's not just promises of future sales. Their Q1 earnings show that profitability is expanding right now. Gross margins have jumped from 35% all the way up to 39%. expanding gross margin by 400 basis points is incredibly hard to execute. So this lends some serious credibility to the idea that ICU Medical is emerging from its messy restructuring phase as a much leaner, far more profitable enterprise. But as impartial detectives, we always have to flip the coin. Let's look at the bear case: bloated multiples and macro risks. The absolute biggest hesitation for value investors here comes down to the premium. IC Medical is currently trading at a staggering PE ratio of 69.7. When you compare that to direct peers sitting at around 26, or the broader US medical equipment industry at just 24.7, IC Medical is sitting at a massive, massive premium. The market is essentially already pricing in a flawless execution of this turnaround, and if they stumble even a little bit, a multiple that high has a very long way to fall. And let's be real, there are plenty of real-world obstacles that could cause a stumble. Bears will quickly point to the risks management outlined in their own 10K. They are fighting ongoing tariff and global supply chain pressures that could easily eat right into those newly expanded margins we just talked about. Plus, there's an active FDA evaluation going on regarding the potential removal of certain IV tubing sets. Combine that with the lingering hangover costs of integrating those massive acquisitions, and the path forward isn't exactly a straight line. These kinds of operational risks are exactly why you'll see something called a valuation allowance in their tax provisions. It's essentially a financial reserve a company sets aside to reduce the carrying value of assets when management has real, tangible uncertainty about whether they'll actually generate the expected future profits to utilize them. For anyone looking closely at the balance sheet, it serves as a flashing yellow caution light. Ultimately, this explainer leaves us with one critical question. When you weigh that massive PE premium against a genuinely successful earnings turnaround and expanding margins, what do you think? Is this just the ground floor of a multi-year reset driven by a brand new pump cycle? Or at nearly 70 times earnings, is literally all the future upside already baked into the stock price? Use the facts we've decoded today to make your own determination. Thanks for hanging out with me on The Explainer, and keep questioning the numbers.